improving country risk management by the tool of sovereign DRR and risk financing tools. And it is my particular pleasure to introduce Madame Bauer, who is the Director of Global Partnerships for the European, Middle East and Asian countries within Swiss Re. Swiss Re, which is located in Zurich, as you know, in our country. Before having this position as a director, she was responsible as a director in communication at Swiss Re, and before responsible for the issue management within Swiss Re. Esther holds a degree in economics from the University of St. Gallen, which is my home canton. We are back to St. Gallen for those who have been here on Sunday evening. And she is a chartered financial analysis. Esther, the floor is yours.
Thank you very much, Walter, for the kind introduction. Ladies and gentlemen, thank you very much for the attention. I know it's tough just before lunch to keep the attention, so I very much appreciate you still being here. In the previous session, it was several times mentioned the insurance plays a part in the overall disaster financing strategy. We heard from the Moroccan representatives that a new national insurance schemes plays an important pillar of the strategy going forward in implementing the recommendation from OECD. We have heard from the French presentation that a review of the implications of the natural catastrophe insurance scheme in France is also envisaged. And Turkey has a very important natural catastrophe insurance pool, which serves as a role model for many new insurance developments in the world. So the role of financing, disaster risk financing and insurance is becoming more importantly. And also the OECD has issued a report a few years ago on disaster risk financing, a methodological framework in collaboration with the G20, and has emphasized that financial resilience is a critical component of effective disaster risk management, and has emphasized the role that finance ministers play. So it's really also a cross-ministerial effort to get to effective disaster risk financing. Since that report and over the last few years, there has been increasing momentum on the subject of disaster risk financing and insurance. And I would like to start with making reference to these big international agreements that have been closed over the last 18 months, which have all strengthened, emphasized the growing role of disaster risk financing strategies and insurance. It says in the Sendai framework, I'm not quoting here the whole paragraph, but there is a paragraph that emphasizes that it is part of this to promote mechanisms for disaster risk transfer and insurance and risk sharing agreements, etc., in order to reduce the financial impact of disasters on governments and societies in both urban and rural areas. Also, in the Sustainable Development Goals, where financing is a cross-cutting theme across all the goals, but there's one explicit goal, number 8, which states that strengthening the capacity of domestic financial institutions to encourage and expand access to banking, insurance, and financial services for all. So it's also explicitly acknowledged there. In the context of the COP climate discussions, especially in the context of climate adaptation, the G20, under the German leadership last year, launched a new initiative now called Insure Resilience, initially started as Climate Risk Insurance Initiative, which has the very concrete target to increase the beneficiaries of this climate risk insurance from estimated currently 100 to 500, currently 100 million to 500 million people by 2020. This is an extremely ambitious goal, and there is a lot of effort going on to find the most effective way to reach these 500 million people. And last, I would like to mention the humanitarian financing discussions. The UN Secretary General last year appointed a high-level panel to make recommendations for humanitarian financing in advance of the World Humanitarian Summit in Istanbul earlier this year. And there was quite some pages on insurance, and it was concluded that promoting insurance scheme would create increased liquidity for early action instead of relying on post-crisis relief itemized assistance. So this is in the context of the global agreements, and in this the insurance industry, in collaboration with the World Bank and the UN, have created earlier this year the so-called Insurance Development Forum, which aims at addressing the barriers that we find in making sure people and institutions have access to insurance and to promote facilitate the development of insurance schemes around the world. The Insurance Development Forum is co-chaired by the CEO of a reinsurance company, not ours, it's another one. It's alongside with the CFO of the World Bank and Helen Clark of UNDP. Different work streams have been identified to tackle specific aspects, like regulatory aspects, like modeling aspects, like technical assistance to identify the needs and best solutions for insurance in different countries. So this is the increasing momentum on the global institutional level, and in addition, on the ground, we have also seen quite some innovative developments over the last 2 to 3 years, which I'd like to share with you going forward. But let's first take a little bit a step back and say, why is this all needed? Why are we talking about this? The losses from natural disasters over the past 10 years have totaled $2 trillion. It's a massive number. And out of those 2 trillion, about 30% have been covered by the insurance industry globally. So on average, the insurance industry has paid out 60 to 70 billion for natural disasters every year. But that's an average. Records were around 130 billion. But that's 30%. 70% is not insured and needs to be financed otherwise. The 70%, at Swiss Re, we call it the protection gap. And I'd like to talk about this protection gap a little bit in more detail. Obviously, an average and these large numbers don't tell the whole story. There are huge differences, and I would just like to mention a few examples from Asia, but we can also cover other examples. There's huge differences. Here on this chart you see the earthquakes in Nepal and in New Zealand, and all the events listed here, Thailand floods, Philippines, Hurricane Cyclone Haiyan, and the Nepal earthquake and the New Zealand earthquake, they all were major impacts in terms of the losses compared to the GDP in those countries. But how they were covered is hugely different. Nepal, hardly anything was insured, relied heavily on donor assistance after the earthquake. while in New Zealand, about 80% of the losses were covered by the insurance industry. In Thailand, about 1/3 of the losses was covered by the insurance industry. In the Philippines, it was a little bit more than 10%. That was of the cyclone losses that were covered by the insurance industry. So this is a picture that, you know, you can find all kinds of examples that just shows a very, very heterogeneous pictures. Even in Europe, it's very, very heterogeneous, both by type of disaster as well as by country. In Europe, windstorms are fairly well covered by the insurance industry. Flood, it really depends by country. For example, France is relatively well covered, the UK is relatively well covered, Switzerland is well covered. But Germany, Italy, Eastern European countries, the insurance penetration is not very high for flood covers, even less so for earthquakes, as we have seen last week after the severe event in Italy and also in previous events. So looking at the examples in Nepal, donor organizations do a fantastic job in raising the desperately needed money after such events. But it's also a little bit a risky strategy. What if that money is not available? What if it's the second, third, fourth such headline events in a year and some donation fatigue emerges? What about the crowding out of money for other desperately needed emergencies that need to be financed? So we need to think about more sustainable and effective ways. These uncovered costs place a significant burden on the public sector in all the countries. Public sector needs to look after the affected population to provide immediate assistance. Governments just can't just walk away if the private, if the people in the countries do not have insurance. We have seen that again last week in Italy. Prime Minister Renzi came out very quickly after the event saying that nobody will be left alone. But if businesses are interrupted, also tax revenues are going down for governments. Plus there are costs for emergency cleanups, access to affected areas. And in addition, the public infrastructure, public physical assets may also be destroyed and cause costs to a government. What are the options to finance these costs? The typical approach has been to finance these costs when they occur after an event through budget reallocations, postponing investment projects that development projects that have been planned to grow the economy. You need to divert money from there potentially to reconstruct what has been destroyed or to intervene immediately. Raising debt is a common approach, but it also very much depends on accessibility to capital markets at the point of a disaster. The conditions in those markets, costs and availability may be not clear or may only come at a high cost. I mentioned donor resistance before, and then obviously any government can always increase taxes, but that certainly comes at a political price. There have been examples I'd like to share with you what happened in the Chile earthquake in 2011. The Chilean government needed a little bit more than 9 billion for the reconstruction of public infrastructure. And how was that financed? In fact, they introduced new taxes, so about 1/3 was actually financed through additional tax. They did go to the capital market. Chile was in a very fortunate position to have very low debt ratio, but hadn't been to the capital market in a long, long time, so that required several months of preparations. But about 1/4 of the costs were financed through that increase. About 10% was found through budget reallocations. In addition, Chile does have a reserve fund, the so-called Stabilization Fund. So that was one of the pre-event financing mechanisms they could access to for about 10%. And in addition, they had to sell state companies, state assets to get additional funding. You may also recall the earthquake in Ecuador earlier this year, where shortly after the government came out and said it would increase value-add tax to finance the reconstruction. So all these post-event financing mechanisms take time to organize after an event, and it's very uncertain at what cost and to what extent they will be available. So that's one of the reasons why in all these international agreements I mentioned at the beginning, the role of insurance is being emphasized, or other pre-event financing mechanisms that are arranged before an event happens, that provide stability in terms of planning in terms of the costs. They also come with a cost, but you know that in advance and can budget for it, and you have then a guarantee after an event. When we talk about insurance solutions, there are many, many different ways of how to tackle the subject and to close this protection gap. This slide here is quite complex, but it's a very important slide to me. Looking at the left-hand side at this gap between the insured loss and the total loss and thinking about how it can be closed. There are many different ways of doing that. And I would like to start in the middle. The typical way has been to try to increase the insurance penetration among households and businesses, so that people and businesses do protect themselves and buy insurance. This often comes in the form through national insurance schemes, national insurance pools. There are many of those around in the world and have been for a long, long time. I mentioned before France, Spain, Switzerland. I mentioned before Turkey as one of the more recent, quite successful ones. I put here as examples the efforts underway in Morocco, not yet implemented, but clearly clear plan laid out, being discussed in Parliament. And I also put down as an example a new scheme that was launched this year, actually, in April in the UK, called Flood Re. I'm coming back to that in a second. So this is, one approach is really to make sure people and businesses buy insurance to protect themselves such that governments and donors do not have to step in. Then going to the bottom of this chart, obviously there are many people around, especially in emerging and developing countries, who cannot afford traditional insurance solutions. So there are many ways on the way to develop simplified products distributed through alternative distribution channels, so-called microinsurance products, to reach the poor. I'm going to talk in a minute about a new scheme that was launched end of last year in Kenya by the Kenyan government to effectively reach the vulnerable poor. And then on top of this chart, so-called macro solutions, so governments themselves can insure their contingent liabilities, if you wish, on the budget. So the funding they need for emergency response, the funding they need to rebuild public infrastructure. This can also be insured. African Risk Capacity is a pool that was launched 2 years ago among African countries to this extent to finance emergency response for drought. And I would like to explain in a minute a little bit more another scheme that was launched this year in the Chinese province of I'm going now quickly through these three examples, the floodry in the UK, the Heilongjiang case study, and the Kenya livestock insurance program. Floodry is an interesting concept because the situation in the UK is different than in many other markets. Flood has typically been insured as part of the standard homeowners property or fire policies in the UK. And there has always been a gentleman's agreement historically between the insurance industry and the British government, that the British government takes care of the prevention measures such that, and the insurance industry in return commits to provide affordable flood insurance. This gentleman's agreement was increasingly tested over the last 10, 15 years as floods become more frequent and the impacts more severe. And it also became apparent that the necessary investments to maintain the flood protection measures or additional investment needed did not really work out well anymore. And the insurance industry saw itself in a situation where it couldn't continue to provide flood at low cost in certain areas. So the agreement fell apart, and all stakeholders saw that a new solution had to be found, as some people in especially flood-prone areas could not afford to buy flood insurance anymore. So in a very unique public-private partnership, the government and the insurance industry created this new vehicle called Floodry, which provides affordable flood insurance to people in flood-prone areas. It is based on the wealth or income of the people, based on the tax brackets that they live, that they pay a premium for, and is being cross-subsidized. This is seen as a temporary solution for 25 years, such that in the meantime, the government and the stakeholders get time to invest in flood defense mechanism, such that over time one can go back to risk-based pricing. This is an interesting solution. It is, I believe, very unique to the situation in the UK, cannot be easily copy-paste, but certain elements of it potentially. But it shows that with the political will and the collaboration among all stakeholders, it is possible to provide affordable flood insurance. The example, the case study of the Heilongjiang provincial government in China is one of where the government itself buys insurance for 28 counties in that province, which have a large portion of the population which are poor and not seen as not considered resilient in the face of adverse events. So where the government would step in to support in case of a disaster. So the province of Heilongjiang bought an insurance policy covering flood, river flooding, excess rain, drought, and the cover against temperature shocks. That allows them to intervene and support the poorer households in the province. This is a scheme that started just a few months ago, and is a very innovative, and there's a lot of development in China at the moment in terms of implementing innovative insurance solutions. So this is the first one of probably many we'll see in the next couple of years. In Kenya, the government took a different approach. Again, the problem was quite similar. They have many vulnerable pastoralists in the country that frequently suffer from drought. So the government had often to intervene and support these pastoralists through government programs. But they wanted to move towards a more predictable scheme using insurance instruments. Essentially, it started as in two counties in 2015 as pilots, is now being rolled out this year to more counties, and over the next couple of years will cover the entire country of Kenya. Essentially, the government buys insurance policy on behalf of pastoralists, but on pre-identified pastoralists. So the government knows exactly who these people are they would support in the case of drought. So the government buys these insurance policies on behalf of these people, and the government has also recognized that the insurance feels that the insurance industry has a better distribution mechanisms to get the money to the people when they need it than the government itself. So the scheme works in a way that the government buys these policies, informs the insurance companies who is eligible. Insurance companies issue then individual policies to these pastoralists and compensate these people in the case of a drought. It's an index-based solution, as is the situation in the previously mentioned China program, meaning that when a drought is being identified through a vegetation index, then the compensation is made to the pastoralist. It is structured in a way that allows to intervene before the animals before the livestock dies. It is designed such that they can buy fodder and water to support the livestock, such that they don't have to, that they're not forced to sell their assets or see it die of drought. So this is just to give you a little bit of an overview of very different approaches that can be chosen. And it really is up to the local stakeholders, private sector, government, to find the most appropriate solution in each country. It's also important to note that, if I go back, these are not mutually exclusive solutions. It makes sense to promote disaster insurance on individual and businesses level, that they protect for themselves. Still, even if every individual had an insurance policy, there would still be significant costs on the government budget for the public infrastructure for emergency response. So it makes sense to complement that with additional solutions. And depending on which country you are, to find particular solutions for the vulnerable poor. Here, just to mention, Kenya, for example, not only has this livestock insurance program, Kenya is also part of the African risk capacity and buys additional insurance protections through that scheme. Now, let me spend just a couple of minutes. Why does insurance matter for disaster risk financing? Different studies and research has been performed in just the last couple of years. Notably, the rating agency Standard & Poor's did a study last year looking at to what extent natural disasters can damage sovereign creditworthiness. And it is quite an impressive picture. This is just a selection of countries, but if you look at the bottom part of these countries, starting from Philippines, Turkey, Thailand, down to Peru, Vietnam, Japan, Bangladesh, Chile, Dominican Republic. Standard & Poor's concluded if a major disaster hit any of these countries, the sovereign credit rating may be affected by more than 1 notch. So many of these countries are already at a critical level, would fall below investment grade if such a downgrading would happen, and would make financing even more expensive than it is today already. So this clearly puts the topic on the agenda of ministers of finance. That's what they look at and care. And it shows that it's not only difficult to insure, but it can also be a vicious circle to making it even more difficult to finance. Standard & Poor's also concluded that insurance coverage can act as a mitigant to this, and I come back to that in a second, why this is the case. The Bank for International Settlement did a study a few years ago about the macroeconomic impact of natural disasters and concluded that countries that are well insured, the macroeconomic impact of a disaster is less on GDP growth and they recover faster. And they said that it's mainly the uninsured losses that drive the subsequent macroeconomic costs. And again, I come back to that in a second, why it is in my concluding slide. I mentioned at the beginning the OECD work, the methodological framework on risk assessment and risk financing, highlighting that finance ministers play a pivotal role in disaster risk management strategies. To ensure adequate financial capacity and rapid release of funds is available, thus enabling swift emergency response, reconstruction of public assets and infrastructure, and targeted financial assistance to the affected people. So why is it that these studies come to the conclusion that insurance, the availability of insurance can mitigate the macroeconomic impact? There are the financial benefits. A key component is that there is guaranteed access to required funds for recovery. This was a key element in the study of the Bank for International Settlement. The fact that there is insurance means there's guaranteed access to funding that gives investors more confidence to invest. So the whole reconstruction starts quicker if there's clarity about the availability of the funds. From a perspective of Standard & Poor's, they look at the contingent liabilities on the government's budget. If they see that the government budget includes a fixed amount and that in case of a major event happening, there is no massive impact on the public finances, that helps in the consideration of the sovereign credit rating. An important aspect of insurance compared to other financing instruments, debts, loans, etc., is that they don't need to be paid back. Yes, insurance has an upfront premium which can be budgeted, but after the event you don't have to pay it back. There are also operational benefits. In the insurance industry occupies professional loss adjusters, loss assessors after an event. That also helps to inform governments and other stakeholders about the potential losses. That obviously only works for traditional indemnity insurance and not for index or parametric insurance. As I mentioned before in the example of Kenya, the insurance industry has established processes to distribute funds. And this is what the Kenyan government has recognized and came to the conclusion that's more effective than the government itself building up these capabilities to reach the beneficiaries and pay out to them. There's another benefit of, but only for the parametric insurance, that there's a faster payout and a flexible use of that money. So there's a little bit this balance between traditional indemnity insurance and parametric insurance. Some has advantages here, the others on the other side. Lastly, I'd like to mention the information benefits for overall disaster management that insurance can bring. Insurance quantifies risks and puts a price tag on it. This is an important information for overall disaster risk management. If you look at how much you want to invest in prevention, how much loss you can avoid through these prevention measures, and how much you cannot afford to prevent, then you can compare these costs and benefits based on the pricing information that insurance provides. In that sense, it also facilitates integrated risk management. I'd like to illustrate this last point briefly. I know it's a very busy slide, but I hope I can make the point. We did studies in more than 20 countries around the economic impacts of climate change, looking at disaster losses today and in the future. Here is just one example of St. Lucia, which was covered as one of 8 Caribbean islands. And if you look at the economic loss that can be expected from an event occurring more or less every 100 years, you see that that loss is expected at 1.4 billion for St. Lucia. Now, the people involved in the research identified with the local stakeholders what prevention measures can be taken to reduce that loss. And various measures were identified in strengthening constructions, roofs, etc., enacting new building code, strengthening evacuation measures, etc. In the case of St. Lucia, unfortunately, there wasn't that much that could be such a 100-year event could be reduced. It could be reduced by 60 million through cost-efficient measures, meaning where the costs to implement them is less than, than the loss you can avoid. So you reduce more than you invest. That's what this says. In other Caribbean islands, the result was totally different. In Barbados, 75% of the total loss can be avoided by prevention measures. Now, a country can say, this was an assumption made, we can afford to bear 350 million of this 1.4 billion. But there is almost 1 billion where we don't see ways to prevent them cost effectively, and we don't have the financial means to bear them. So what you see on the right-hand side is the analysis, what else can be done for these almost 1 billion. They could invest in further mitigation or prevention measures which are not cost effective, meaning they cost more than what they prevent in terms of loss. So, but still, that could make sense to save lives, and it's considered worth the effort. So to cover 60%, to reduce 60% of this 1 billion, so 600 million, they would have to invest 100 million every year. Obviously, a societal political decision, if this is worth, an alternative consideration could be, okay, we know we don't have the financial means to do so, but at least we want to be prepared financially. Then an insurance cover for this roughly 1 billion, that's what the 100% coverage level indicates, would cost around 30 million. This is not to say this is the preferred solution. This is really putting the facts on the table from a cost perspective and allowing the decision makers to decide what is their preference and what is worth doing. So this little excursion at the end was to illustrate my point about the information benefits and what I mean when I say insurance puts a price tag on risks. I'm concluding my remarks here. I hope I've been able to give you a little bit of sense of why financial resilience is a critical component of effective disaster risk management, and I look forward to your questions, comments. Thank you.
Thank you very much, Esther BAUR. We have time for 2 short questions before then going to lunch. There's a gentleman in the back, please. You get the microphone.
Hi, my name is Robert Muirwood from Risk Management Solutions. I'm interested if you think that insurers and reinsurers ought to have transparent profit margins for writing the business in developing countries and work to lower profit margins than you would in developed markets.
That's a very good and interesting question. You know, it is a market, and I think we need to ensure that there is a sufficient competition and a market around it. It's a bit a tricky thing to say, let's publish profit margins around the world, because also the modeling is not, there's not one view on modeling. There are different views on modeling and quantifying the risks. So, and insurers invest a lot in developing their own views and tools. So that's their prime proprietary asset to actually do business. In sharing that publicly to everyone is a tough commercial decision, and I think this is one of the key questions that the Insurance Development Forum that I was referring to at the beginning is looking into. The whole access also to models is an important question, and all these aspects are being addressed in the context of the Insurance Development Forum.
There is another question over there.
Regis Depot from Saint-Greg. Thank you very much, Esther BAUR, for this very nice international presentation. I've got a question in link with the precedent panel, because it has been said that with the new Sendai framework, there was some new ideas, especially more relations between private and public actors, and also to develop Build Back Better. And in my Paris flood case, you know, I'm trying at this moment to develop Build Back Better. It's not easy, as you imagine. And for people here, maybe some don't know, but it means that you must prepare to reconstruct after big event, big natural hazard in a better way. And at this moment, I'm trying to get money just to organize some preliminary studies about the way we can reconstruct railway tracks and electrical devices and so on and so on. Do you imagine, it's not a question for Swiss Re, of course, but do you imagine that it should be possible to involve the insurance system in financing preliminary studies for Build Back Better?
You know, I think this is a very fundamental question about the public goods and who finances public goods. I think the most important role that the insurance industry can play is when you build back better by offering better insurance conditions in that circumstance, so that you benefit from lower rates when you build back better. I think that's the primary role that the insurance industry can play. I think such a study, if you want to get the financing for that, one would have to think whether this is something this Insurance Development Forum or another insurance association or forum could finance. I would like to make one more comment to the question before about the transparency, because it's really a big issue, and there is, and I think the insurance industry needs to do more to become more transparent in that regard, because there is the preconceived notion that it's very expensive and the insurers make a lot of money. But at the same time, we also realize when we talk about bringing more insurance to developing countries and offering more capacities, it's not a supply side problem. There is enough capacity in the markets. It's what is really the scarce resource is the capabilities, the capacities to identify the needs and to develop the appropriate insurance structure solution for your particular need. When we come and advise a government, we're not a neutral party, so they're not in a position to decide whether that's a good and fair deal for them. So that's one thing that, again, the Insurance Development Forum tries to address. But back to the profitability perspective, if you ask representatives of the African risk capacity, for example, you will notice that there's tremendous interest from reinsurers providing capacity. They could place that program 3, 4, 5, I don't know how many times, and I don't think any reinsurers makes money in that. So there's a lot of investment from the insurance industry to develop such schemes.
There are several additional questions. We are a little bit running out of time, so I would propose to take 2 additional very short questions, very short answer, so that we can end at 1 o'clock sharp. I think there was one question on that side, and then you are second.
Thank you very much. My name is Simone Quattrini. I work for the United Nations Convention to Combat Desertification. I will be very short with my question. First of all, I appreciated very much the presentations and the various examples you provided of different types of insurance schemes, including the one in Kenya and also the one in the UK. My question is, since you alluded to the important barrier, let's say, of affordability of premiums or affordability of the whole scheme for a government, I was wondering if you could elaborate a bit more, for example, taking the flood re in the UK, how much, at least in terms of percentage, is the subsidized part of the premium from the UK government?
There is no subsidized part from the UK government in that sense. The UK government has enacted the regulation in the sense that the private insurance industry has created flood re, has capitalized it, and that capital has been raised through a tax on the insurance. So basically it's a cross-subsidization among the homeowners within the UK. Now there is a certain risk that only the people in high-risk zones buy the flood insurance from flood re, while all the, what we call the good risks, those people in low-risk areas buy the traditional policies from the private market. So there's a choice between that. Flood re could go bankrupt if, you know, if the price is not enough, if only the people in the low-income people in high-risk area buy that flood policy. So the government has enacted a regulation that if that capital, that current tax is not enough, then flood re can raise additional tax. So that's the indirect subsidy, if you wish, from the UK government, but there's no money out of the government budget flowing into the scheme. It's really a tax that does cross-subsidize across the income classes within UK.
And the very last question, please.
Thank you. My name is Eugen Diemel-Belleke. I'm from GOPA Worldwide Consultants in Germany. There are about 600 to 700 million small-scale farmers worldwide. They produce about up to 70% of the world food. Most of them are prone to natural resources problems, disasters, most of it related to droughts and heavy rain. The problem is how to organize these small-scale farmers in the different countries. You have given the example of Kenya. It is very difficult to do so. It's a very difficult undertaking, but I'd like to have an idea from your side how to organize these farmers in groups, in bigger groups, country-wise, regional-wise, and would you say that the index-based approach is the right one for the different insurance categories? Thank you.
Thank you very much for your question. In brief, first of all, I think you allude to a very important challenge that in order to reach the 600, 700 million smallholder farmers, you need to aggregate them into groups. The earlier efforts to try to provide microinsurance to individual farmers, there have been many pilots, but it's difficult to upscale. So we need to reach the so-called aggregators in value chains, for example. That's one way of accessing. Governments themselves can be one of the aggregators. Financial institutions can be such aggregators. So all those that serve these farmers in other ways, through seeds, fertilizer, financing, or are off-takers or processors of the produce that the farmers produce. So that's to your question number one. And the question two on index insurance, I think it would always be preferable if you can offer traditional indemnity insurance, but it's often not feasible from operational perspective. The costs are just prohibitively high to do loss adjustments in very remote areas. So it's not often not a question indemnity or index. That's what is doable in that area. But there are many different forms of index insurance, and they are also evolving fairly quickly over time.
Thank you very much, Esther. I know that there might be much more questions, but there is time during lunch break for also contacting Esther BAUR. At that stage, I just wanted to thank Esther BAUR for an excellent insight in all the different insurance schemes, in the role of insurance, the role of insurance in terms of being a part of an integrative risk management approach. Thank you very much, Esther BAUR. And this also gives me the opportunity to express my sincere thanks to Swiss Re as one of our sponsors on a platinum level since the very beginning. Swiss Re always has supported us, and for this we are very thankful. And without Swiss Re, by the way, we would probably no longer exist. So thank you very much, Esther, for an excellent keynote. Thank you so much. Thank you.